Welcome, everybody. My name is Stan The Annuity Man. Welcome, all of you out there, for the first ever The Annuity Man live event. My name is Stan The Annuity Man. As I said, I'm America's annuity agent licensed in all 50 states. I really appreciate you joining me on a really nice Saturday. Thank you so much. Today's topic is MYGAs, multi-year guarantee annuities. Now, let me give a brief background on MYGAs, and then we're going to open it up for questions. So if you have questions, please type them in, and I'm going to try to get to every single one of them, hopefully, that I can, unless they're just like, Stan, why does everyone hate you? And even then, I'll probably answer it. And that's okay. If you don't like annuities, I'm glad you're here. Multi-year guarantee annuities are the annuity industry version of a CD, okay? It pays a guaranteed interest rate, a guaranteed yield, for a specific period of time that you choose. Now, on my site, theannuityman.com, there's a live feed of the best MYGA rates for your specific state. Now, all the MYGAs, multi-year guarantee annuities, are fixed rate annuities. They're regulated and issued at the state level. So if you're in California, the availability of MYGAs in your state is going to differ from if you're in Texas or Florida or New York or wherever. Okay. Now, we are licensed in all 50 states, so we got you covered. But when you go to my site, theannuityman.com, if you want to see the live rates as we're talking on this or later, you can shop them 24/7, 365, which is cool. There's going to be a drop down box. You're going to put in your state and then the duration you want to see, 3 years or 5 years or 7. And you can go back and forth and look at all of them. And then you're going to hit a box called See Rates, and then it's just going to pop up the highest yield to maturity from top to bottom. Now, one of the things I encourage you to do is go to my site and schedule a call with me. No obligation, no cost, 30 minutes, just me and you, brutally honest, brutally factual, just like this right here. Because when you choose MYGAs, we need to talk about the claims paying ability of the carrier and some specifics about MYGAs. MYGAs, they're all pretty much the same, give or take a few asterisks. And those are the things that me and you need to talk about. Like, how do you want the death benefit to work? If you want it joint with a spouse, can you use IRA, Roth IRA, or non-qualified accounts, and which is the best? You can use them all, obviously. But the main difference between a multi-year guarantee annuity from a functionality standpoint and a CD is with a CD and a non-IRA, non-qualified account, you're going to pay taxes on that interest with the CD. With a multi-year guarantee annuity and a non-IRA, non-qualified account, that interest goes tax deferred. That does not make it better than a CD. But MYGAs and CDs can be used in combination. And currently, MYGA rates are beating CD rates. If you've gone out there to, say, bankrate.com and shop CD rates, I mean, it's pretty tough. It's pretty low. But multi-year guarantee annuities are much, much higher. The reason is there's just a dynamic pricing model. Life insurance companies issue multi-year guarantee annuities. So they're pricing not only current interest rates, but also the bonds they have in inventory. They're also looking at the life insurance policies they issue and the lifetime income policies they issue. And they're combining all of that to offer the guarantee and back up those claims. One last thing before we open it up for questions. I have written a book on multi-year guarantee annuities. It's called the MYGA Owner's Manual. If you don't already have it, go to my site, sign up for it. We will send it to you for free and under no obligation. No one's going to call you. No one's going to show up at your door. So that's the 30,000-foot view elevator speech about MYGAs. So let's open up the questions and let's get to it starting right now. So the first question that I got in is, tell me about the state guarantee fund, Stan the Annuity Man. And that's a very good question. Okay, the state guarantee funds back up multi-year guarantee annuities. But I think you should always look at the claims paying ability of the carrier. Now, a state guarantee fund is not as good as FDIC, which is backing the CDs, as you know. State guarantee funds, every state has a specific dollar amount that they will back your policy per policy, per owner, per company, and all of the rules are different for each state, and we can go over that. But state guarantee funds are good to have. It's a nice safety blanket, but they've really never been tested. And I guess that's a good thing. That's a good thing for the annuity industry, because I always tell people annuity companies aren't smarter than banks. They're just more regulated. With a fixed annuity, and there's many different fixed annuity types, but multi-year guarantee annuities fall under fixed annuities, that category. The annuity company has to have on hand 100% of your initial premium day one in investment grade bonds or those type of investments, liquid, so they can pay you back if needed. Now that's a pretty stringent handcuff on the industry, but I think it's good and it's pro consumer. Now we can go down the rabbit hole and you can say, well, Stan the Annuity Man, let's talk about investment grade bonds. But in the world that we live in, as you know, I mean, that's as good as it gets. I mean, it is what it is. So that's a good question. Another question and I'm getting, by the way, I'm getting questions. Not only people are texting me, they're putting it on YouTube Live. So I'm getting it from all places. So I'm holding my phone and I'm reading some of the text messages right now. The other one is, Stan, what's the longest duration MYGA that you currently are recommending? That's a good question. That came on through the text on my phone. Currently, just looking at basic yield curve analysis, and that's kind of what I do. And in Southern, I'm from the South, yield curve analysis means where's the sweet spot? Where are they rewarding you for with the highest yield? And currently, at the time of this taping, at the time of this The Annuity Man YouTube live event, it's about 5 years. Now, can you lock in longer than that? Yes. Does anyone know where interest rates are going to go? No, of course not. But I just tell people 5 years, and if you go to the MYGA feed and look at the rates, you'll see that that's really where the highest yield is, and the companies are really not rewarding you for holding or going out farther than that. You can if you think rates are going to go lower. But what I also tell people is not only to look at the yield curve analysis, and I'll tell you, if I think if you're locking in too long, but also remember, with MYGAs, you can ladder the purchase. I got a call the other day, and a guy said, I want to put in $300,000 in MYGAs. I don't want to pay taxes on the interest, so I'm using non-IRA funds. Which carrier? Which duration? And there's no good answers, just bad sales pitches, as you know. And I don't sales pitch; I tell the brutal and factual truth. I said, why don't you consider laddering, doing 100,000 in a 3-year, 100,000 in a 4-year, and 100,000 in a 5-year? Because none of us know where rates are going to go. And then every year, starting at year 3, we'll have money that's available to hopefully attach and transfer a non-taxable event to another MYGA at that time. So that's the answer to that. Another question coming in from Michael from, I believe, is in North Carolina. And he's mentioning North Carolina is the state guarantee fund is 300,000. Is there a way around it? So 600,000 for my wife and myself. There is a way around it. It's a very good question. So let me synopsize the question again. Michael has $600,000. The North Carolina, I believe he's from North Carolina, has a $300,000 limit per policy per owner with the state guarantee fund. What I would tell him to do is choose 2 carriers. And if it's non-qualified money, or even if it's IRA money and the wife has an IRA and he has an IRA, then you can put in up to that amount and then be covered. So let's just say Michael has $300,000 in an XYZ annuity, and his wife has $300,000 in ABC annuity. Then they're both covered under that state guarantee fund. But once again, I'm going to emphasize that don't make your decision on the state guarantee fund. Make your decision on the claims paying ability of the carrier, which leads me to another question that kind of came in similar to that. I always tell people I have a different analysis, because when I look at these carriers, and if it's on my site, if it's gotten to my MYGA feed, then I've done the analysis to look at the bonds and all that stuff. Then even if it's a B plus company, B double plus, A minus, I have made the analysis that for that duration, that carrier can back up the claim. That doesn't mean that we would buy the same carrier for a lifetime income guarantee, transfer risk for lifetime income. This isn't a lifetime income product. Multi-year guarantee annuities are a principal protection product that pays an interest rate. Remember the PIL. If you don't know that, I have an acronym called PIL. P stands for principal protection. I stands for income for life. L stands for legacy. And the other L stands for long-term care. Those are the 4 things that annuities contractually solve for. So MYGAs fall under the P of principal protection. So you just need to be aware of that and aware of the companies, but we're not marrying them for life. We're marrying them for the duration. So let's just say there's a B plus rated carrier that has a really high interest rate for a 2-year MYGA. In essence, we're marrying them for the 2 years. And your question to me is, Stan, can they back up the claims for the 2 years? And I'm either going to say yes or no. I'm going to be brutally honest because my rear end's on the line with that as well. So that's kind of the way that I look at MYGAs and that I analyze them as well. Remember, I have a background with all the wirehouse firms, Dean Witter, Payne Weber, Morgan Stanley, and UBS, and I manage bonds at a pretty high level. So I do understand how to look at these carriers, how to look at their solvency ratios, their bond holdings, their financials, and things like that. And as I always say, I can kind of spot when the son-in-law's buying the bonds. The CEO hired the son-in-law, and the son-in-law doesn't know what the heck they're doing. And if that's the case, they will never show up on my MYGA feed. So here's another question that came in. It's from Lee. Worst case, if the insurer goes under, what is the delay for the reimbursement from the state backup? Well, we don't have a lot of case history on that, Lee, and that's a good thing. There was a case 30 years ago, and yes, I've been in the business a long time, so I remember it. That was kind of the origination of the whole state guarantee funds, and there was a company in California that went under, and it took, my memory serves me correct, it was about 6 months to get everybody whole from that specific situation. In 2008, there was one company that was absorbed very briefly by the state guarantee fund, and then a carrier came in and bought them hook, line, and sinker and backed up the guarantees, which I think is another thing that you have to put in your back of your mind. Remember, annuities, regardless of type, you can't say I hate all annuities because that'd be saying like you hate all restaurants and you hate your Social Security and you hate CDs. That's crazy. But the annuity industry self-polices. In other words, with 10,000 baby boomers reaching the age 65 every single day, a lot of them, you, me, are looking for contractual guarantees. The industry knows that. So the big carriers are not going to let some small company from XYZ state mess it up. They're not going to allow them to gore the golden goose of contractual guarantees. So I think I call it the annuity mafia. I mean, people laugh when I said that, but it's kind of true. And it was proven out in 2008 when that one company was absorbed by the state guarantee fund briefly, and then another company came in and immediately swiped them up. Stronger company, backed up the guarantees, all as well, et cetera, et cetera. And I truly believe, as we're in a demographic tidal wave, as I said, 10,000 baby boomers reaching the age of 65 every day. I think the industry is going to self-protect, self-police, and that is good for you as a consumer. Does that mean we go buy a C-rated company? No, that doesn't mean that at all. We're always going to make the decision on the claims paying ability at the time when you make the purchase without regard to the state guarantee fund and without regard to the annuity mafia. We're going to say, can this company back up the claim for that specific duration, or if you're laddering durations at that point in time? That's what I'm going to do. So that's the answer to that question. Here's another one, good one. Christopher asked, what happens to the annuity if the annuity buyer dies during the contract period? Very good question, Christopher. Let's talk about that. If you're using IRA assets, Christopher, and let's just say your spouse is the beneficiary, the primary beneficiary of the policy, and you die, that spouse can take over the policy. Okay, but let's talk about she can take over the policy. But let's just say it's a non-qualified annuity, a non-qualified MYGA, non-IRA is what I mean by non-qualified. And you have your two children as the beneficiaries, and you die within the contract, early in the contract. Let's say you had a 5-year MYGA, you died year 3. Okay, then those two kids, if it's a 50-50 split, are going to get the lump sum plus the interest at the time of your death. Now, I'm going to throw a little asterisk in there, and this is not some sales pitch, but this is the reason that we need to talk at the end of the process when you make a decision to purchase a MYGA. About 5% of the companies out there, and some of them with the highest yields, will have a provision in there that if you die within that surrender charge period, give you an example. You have a 5-year MYGA and you die year 3, then surrender charges will be applied. You need to know that, and I'm going to tell you that. But the other 95% of MYGAs don't do that. The other 95% of MYGAs, when you die, regardless of if you die, you're going to get the policy value. And the policy value is principal plus whatever accrued interest has happened up until your death. So there's a lot of people say, I just want the highest yield. I don't really care about my beneficiaries. That's fine. Those are the conversations that you need to have at the end of the process. But that's the answer to death benefit. And it gets a little bit more complex than that. That's the reason that I need to talk with you one-on-one. But just understand that it works like a CD. You die, and your beneficiaries are going to get the money lump sum in the vast majority of MYGA cases. Also understand this: with beneficiaries on your policy, you can change that at your discretion as many times as you want. So if someone makes you mad, then you can change it up, and you can have, for example, you could give an example. You could have the wife as the primary beneficiary, and then you could have the two kids as the secondary beneficiaries, 50-50. So if the wife dies, then they move up to primary and split the proceeds 50-50. So very good question. Here's another one that came in. I'm not going to do last names. I don't think you want me to, but this is from John. If I purchase an annuity with qualified funds, does the money I am paid out count as RMDs? Well, first of all, with multi-year guarantee annuities, it's not a payout. It's not like a single premium immediate annuity where it's a lifetime income stream. You're going to be taking withdrawals from that, whether it's interest. And by the way, that segues into another question, John, and let me cover that as well. With MYGAs, with some of them you can take out the interest. With some of them you can take out up to 10% annually without penalty. Some 5%, some 10%, and some of them will not allow you to touch the money without penalty during the duration. That's another reason that we need to talk and dig down. And on our site, we list all of that. Which one allows you to take interest out and all of that. But getting back to his question about required minimum distributions, if you're taking money out of that, it would be considered required minimum distributions. But remember, with required minimum distributions, let's kind of look at that for a second. When you had to take required minimum distributions at the time of this taping, it's 72, and they're talking about raising it to 75, but it's now 72, used to be 70 and a half. And you have a myriad of holdings in your IRA. You have stocks and your bonds and ETFs and MYGAs, whatever. The IRS doesn't care if where the money is coming from, where that percentage that they're requiring you to take out comes. You can take it from one source, ETFs, or you could take it from the annuity, but you don't have to take it in proportion. But you can. Let's just say you said, Stan, this is where I want to put the money, part of my IRA in this MYGA, and I'm going to withdraw money to cover RMDs. Once again, we have to talk about these. If the MYGA is RMD friendly, most of them are, not all of them are in the annuity industry. It's like herding cats. That's kind of the reason you need me and my expertise at this, as Stan the Annuity Man, to tell you that, I'm going to ask that question. Tell me, you're putting this MYGA in your IRA. Tell me if you're planning to take required minimum distributions from that. And if you are, then we're going to find that MYGA that is RMD friendly. And so that withdrawal from the MYGA will count towards your required minimum distributions. Let's do another question. They're flying in here. I love that. Steve asked, how do you make the MYGA function exactly like a CD? If you pick a 3-year guarantee, can you take the interest out monthly or annually and close out the annuity after 3 years without penalty? The answer is yes, Steve. So let's take that example. Let's say Steve bought a 3-year MYGA, and the MYGA allows you to peel off the interest without penalty. And let's just say that interest rate is 2.5 or whatever, 2.25, whatever it is right now in the 3-year, depending on your state. And you can see that if you go to my feed at the site. And you just peel off the interest, every month. Yeah, we send you the interest. We send it to the bank account that you tell, not we, the carrier sends it to the bank account that you tell us to. All right. And then at the end of the 3-year term, you've peeled off all the interest, and all of the initial principal is still there. And by the way, MYGAs have no annual fees, no moving parts, no market attachments. So if you put $100,000 in and you peeled off the interest for 3 years for those 36 months, and then at the end of the term, guess what? You have $100,000. We can send you that in check form, or we can transfer it to another MYGA. So that is a very good question. Yes, it does function in that fashion like a CD. I want to be very clear, though. CDs and the FDIC backing that CDs offer is the best backing of all time, because F stands for federal and F stands for we're going to get your freaking money by taxing it. All right. State guarantee funds do not compare to FDIC. And by the way, it's illegal. It's actually illegal for an agent or advisor to mention state guarantee funds in a sales presentation. The only reason I even brought it up is someone asked the question. That's the only way that I can bring up state guarantee funds. So that kind of tells you a little bit more from an insight standpoint on why we need to focus on the claims paying ability of the carrier. So I hope that I answered that question for you, Steve. And by the way, if you don't want to ask the question on this platform, you can always email me at stan@theannuityman.com. You can always go to the site and schedule a call with me. I do answer my emails. Anyone out there that knows that, I mean, I'm on it, and I'm on top of that, and I will interact with you via email if you just want to do that and not do this YouTube live, and have your question read out loud by Stan the Annuity Man. So here's another one. Robert says, what percent of a portfolio should be in an annuity? Very, very good question. And I'm glad that you asked that, because this is a problem, in my opinion, Stan the Annuity Man, America's Annuity Agent, about how annuities are sold. The annuity industry, okay, they do not like to see more than 50% of your investable assets, non-home, non-car, not art, investable assets, not more than 50% in annuities of any type. And remember, there's all kinds of different annuities. You can't just say, I hate all annuities. There's MYGAs and immediate annuities, deferred income annuities, qualified longevity annuity contracts, indexed annuities, variable annuities, charitable giving. I mean, there's a bunch, okay? But the annuity industry is very conscious of people placing too much money, or agents trying to convince you to place too much money into annuities of any type. So if you said to me, hey, Stan, this market is making me wheezy and my stomach's hurting a little bit, I want to take some risk off the table. Because remember, annuities are contracts. They're transfer of risk strategies. They're not investments. They're contracts. Don't believe me? You're going to get a contract in the mail. And you said, I got $1 million. How much should I put in? I'm going to tell you $500,000. I'm not saying you have to put $500,000. I'm just saying that's the limit that me, Stan the Annuity Man, America's Annuity Agent, who follows the rules, will feel comfortable with. And the only way that, and I see, unfortunately, I got a call the other day, and a very nice lady from Indiana, and she had $1.6 million, and somebody, unfortunately, sold her 1.3 million of that, took 1.3 million of the 1.6 and sold her annuities, plural. The only way they got away with that is to doctor or not fill out properly the application. And that's unfortunate. She's way, way too allocated in annuities. And unfortunately, the person that sold her the 1.3, obviously they're going back to the well again to try to sell that last round. And I said, listen, you don't need any more annuities. So 50%, just put that in the back of your head. Could we go to bat with a carrier? And if you wanted to go to 55, yeah, I would use that bullet for you if you told me the reason why. But just put 50% in the back of your head as kind of a bogey. Here's another question. I love the title of this person. The old ultra runner. That tells me a lot about you, which means that you're dedicated and you like pain. Meaning you're running this ultra marathons. I can barely walk on the treadmill, so I'm a little envious. For qualified MYGAs, meaning when he says that, that's MYGAs inside of an IRA. That's what qualified means. Will we be paying IRA custodian fees for each MYGA purchase? The answer is no. So I know with brokerage firms, and having worked with Dean Witter, Payne Weber, Morgan Stanley, UBS, they just nickel and dime you with fees. Nothing against them. Love those people. My two partners are still there. Okay. But you see a $30 fee and $45 fee and $60 fee, account fee. That doesn't happen in the annuity world. Okay. When you transfer the money, and let's just kind of go through that with the old ultra runner, that was his name. Let's just say you had an IRA at Vanguard. Okay. And you said, I want to take a portion of that and I want to transfer it to a MYGA. First of all, my team takes care of all of that from start to finish. We do all the paperwork and get in the weeds for you. Okay. But that transfer from a Vanguard to the multi-year guarantee annuity that you've chosen is a non-taxable event. Doesn't trigger any taxes whatsoever. But the account, and the question is, does the account at the annuity company, they're going to nickel and dime me with fees? The answer is no. It's just not going to happen. And I love that. I love the fact, and maybe it's because, annuity companies, which is life insurance companies who issue annuities, they have the big buildings for a reason, right? I mean, they know when we're going to die. They have the big logos on the plane, and as my CEO says, she says, yeah, and they're also starting to sponsor sports stadiums. She's right. But they don't nickel and dime you with free fees, which is a very, very good question. But you need to know that. Here's another question from Heartman85. Hopefully you're 85 and you're an ex-heart doctor. No, I'm kidding. You said that when a MYGA matures, you can roll it tax-free to another annuity. What about the interest? Is it taxed at maturity? So let's take this in stages. Can you roll it into another annuity without taxes? Yes, regardless of the account type, whether it's a traditional IRA or a non-IRA, at the end of the duration, the surrender charge time period, you can transfer it without penalties. It's a non-taxable event. And yes, both principal and interest transfer without triggering any taxes. So in an IRA, it's an IRA to IRA transfer. So we go from the MYGA that has the IRA set up for you to another MYGA that's going to have an IRA set up. Again, we'll take care of all that paperwork for you. But if it's a non-IRA MYGA, and you're using like checking account money or savings account money, you can still do a non-taxable event transfer to another MYGA at the end of the term if we determine that's in your best interest, okay? And that's called a 1035 exchange. And you say, Stan, 1030, what the heck is 1035? Well, the IRS code, if you're so bored, go to section 1035 and it says you can transfer annuity to annuity, non-IRA, and it's a non-taxable event. So the IRS approves of the 1035. So a hockey analogy, you can keep pushing the tax puck down the ice, which is fantastic. Now the cost basis transfers, but both principal and interest transfer. And then the next question, is it taxed at maturity? No, it's not. Again, we can transfer it. Now, when you finally decide to, if you said, hey, Stan, we've done this a couple times, just send me all the money, then you're going to pay taxes, last in, first out, gains first. If it's non-IRA, if it's IRA, obviously anything coming out of an IRA is taxed at ordinary income levels. But here's another thing that you can do. Let's just say at the end of the MYGA term, your goals have changed. And I always ask people two questions all the time. I say, what do you want the money to contractually do? And when do you want those contractual guarantees to happen? If you're buying a MYGA, your answer is, I want principal protection and I want the yield to start now and I want it for this duration. Okay, great. But let's just say at the end of the term, you say, me and the spouse, me and the partner want lifetime income. We can transfer that multi-year guarantee annuity, once again, non-taxable event transfer, to an immediate annuity or deferred income annuity if you want income down the road. So annuity to annuity transfer, IRA to IRA transfer, you can do that within different product types. So you can go to MYGA to SPIA, immediate annuity, MYGA to DIA, deferred income annuity. If it's IRA money, you could go MYGA to QLAC, qualified longevity annuity contract. You could do MYGA to income rider if you want to do that, or MYGA to indexed annuity. But it really comes down to what your contractual goals are. Remember, these are contracts. I do not sell hypothetical, theoretical, back-tested, projected, hopeful agent return scenarios and what I call unicorns chasing the butterflies. I don't do that. I only sell contractual guarantees. So if we get to the end of the term, you say, you know what, we really need a lifetime income stream, then we're going to go shop all carriers for the highest contractual guarantee for your specific situation for lifetime income, if that's the goal. But if the goal is, hey, Stan, let's just keep pushing the tax puck down the ice, let's just keep locking in rates, this is simple stuff, then we do that as well. Here's another one from Jeffrey. Any limitations on 1035 of the type of annuity conversion from MYGA? I think I just covered that, but let's cover it once again. Thanks, Jeffrey, for letting me and allowing me to talk about that again. Yes, MYGAs can be transferred to other types of annuities, whether that's single premium immediate annuity, and once again, that's for lifetime income, deferred income annuity, lifetime income with income starting later, qualified longevity annuity contracts. If the MYGA is inside of an IRA, traditional IRA, that's for future income. Or you could say move it to a MYGA to a fixed indexed annuity, which is also a CD type product. You could do that with an indexed annuity attached with a rider. You could transfer it to a variable annuity. I don't sell variable annuities. I don't have anything against them. I just don't sell anything that has the potential to lose value. And as you know, variable annuities have mutual funds. They call them separate accounts as the internal investments. Let's get to another question. Tim asked, with inflation in the headlines And our favorite person, Miss Yellen, he didn't say that, I said that. Miss Yellen revealed that there could be a rise in rates. Historically, what will it take for the insurance company to raise their MYGA rates? That's a really good question. And there's nobody knows where rates are going to go, even Miss Yellen. If you look at the 10-year Treasury, and I'm going to geek out on you a little bit here because I'm kind of a math geek, and from all the firms where I was at Morgan Stanley, Dean Witter, Payne Weber, UBS. The 10-year Treasury right now in the United States seems low because we all remember Jimmy Carter rates. But if you look at the 10-year Treasury equivalent across the world, excuse me, the 10-year Treasury equivalents across the globe, we still pretty much have the highest rate. But yes, we all would love to see rates move up. So getting to the second part of your question, which is, how are the annuity companies? It's a competitive world. If CD rates start rising, MYGA rates are going to start rising. They're trying. Remember, MYGA companies, annuity companies, life insurance companies that issue annuities, MYGAs, they're trying to attract your premium. They're trying to attract your money and make sure that they can back up the claims, etc. So I kind of liken it to, we all went to the junior high school dance, and that was when all of us were afraid to talk to anybody, and there were boys on one side and girls on the other, and all it took was one or two crazy ones, one boy and one girl, to go out there and dance, and then everyone started dancing, right? The way I look at MYGA rates is a lot of these companies are waiting. Well, when rates do eventually start rising, hopefully, cross my fingers, cross your fingers, then they're going to react accordingly because it's a competitive world. Remember, MYGAs are commodity products. I mean, that's the reason you go to my site at theannuityman.com and pull up all the rates, and it changes, and it's a 24/7, 365 service that you don't have to sign up for. You just go see it. But the answer to his question is, if rates start moving, you'll see MYGA rates start moving. Typically, there's about a 3 to 6 month lag. I've just looked at that historically. I don't have any like studies that I've found. The study I'm quoting is me being in the business forever and just seeing the hesitancy sometime of insurance companies, life insurance companies that issue MYGAs to raise rates. But it really comes down to if one carrier goes out there and raises the rate 50 basis points, it makes the others stand up and look. 50 basis points, meaning 0.5%. It's going to make the other carriers go, whoa, wait a minute, we might need to step in there. So the good news is it's a competitive world. The good news is that we represent pretty much all carriers, which means that we are, when you're checking my site for rates, you're going to see the best and current rates at that point in time. But I'm crossing my fingers with you, Tim, on the fact that I hope rates go up. Another question that I just got in, which is, and I tell you what we'll do. This will be the last question, because I don't want to keep you that long. This has been great, by the way. We've gone 30 plus minutes with all this. But here's the question, and this is a really good one. Okay, which one should I buy? And this is from a guy named Scott. Which one should I buy, MYGAs or indexed annuities? Because I have been pitched indexed annuities with the promise that they're going to get 5 to 7% return. Okay, that's a good question, Scott, and I'm going to tell you, this is the kind of the problem with the annuity industry. You're going to have, most of you out there, if you have been talked to an agent or talked to an advisor or gone to the bank or gone on the internet, everyone's trying to sell you an indexed annuity. And an indexed annuity, a fixed indexed annuity, FIA, and by the way, I've written an owner's manual on that. I'd be happy to send you. That was designed in 1995 to compete with CD products. MYGAs are on the planet to compete with CD products. The difference between a multi-year guarantee annuity and a fixed indexed annuity, okay, is the fact that the multi-year guarantee annuity yield is contractual. It's contractually guaranteed for the term that you chose. So if you chose a 3-year, that interest rate is guaranteed for that 3 years. If you chose a 5-year, that interest rate is guaranteed for 5 years. Okay, but with indexed annuities, number one, most of them are longer term. Most of them have 7 to 10 year lock-in periods. Yes, there are shorter ones, but we can talk about why those aren't as attractive from the standpoint of a potential return standpoint. But indexed annuities the returns are based on call options, okay, and there's no guarantee of the return. So if you really want a guaranteed interest rate, you need to go with MYGAs. Also, too, MYGAs allow you to lock in money short term. And I think in this current interest rate environment, short term is good. I mean, short term is good in an interest rate world where we really don't know where interest rates are going or headed. I'd rather you keep the maturity short. That didn't mean that we don't sell. We sell more index annuities. Probably we sell a bunch. And the way we sell them is for people to understand their CD products, and they're also an efficient and cost-effective delivery system for income riders. But remember, they were put on the planet in 1995 to compete with CD returns, regardless of what you're being pitched. Remember, if it sounds too good to be true, it is every single time. One last question that just came in from a person named Fred. I'm going to just, one last question. This is it because we all have to go. And his question is, what are my choices at the end of the MYGA term? Like he bought his thing at the end of a 5-year MYGA. At the end of a 5-year MYGA, regardless whether it's an IRA, non-qualified, non-IRA, or Roth IRA, you can put them in Roth if you want. At the end of the term, you have a couple decisions. The first one is, hey, Stan, send me all the money back with interest. Fine. That we'll contact the company. We should sign the appropriate forms, and that money will be sent to you. Or if it's an IRA, you can talk to your IRA, say at Vanguard, and have them initiate the transfer for the money to come back to Vanguard. You can do that. Or you can just cash it out. Hey, Stan, send me the check. If it's non-IRA, we send you the check. You pay taxes on the interest, last in, first out at ordinary income levels. The other choice, as we talked about earlier in this event, was that you can transfer it to another carrier from the standpoint of another multi-year guarantee annuity, or you can transfer it to another product type, an immediate annuity, a deferred income annuity. One last point that I want to point out. At the end of the term, the carrier that you're currently with is going to make an offer for you to stay, what's called a renewal rate. That renewal rate, we're going to get, if it's higher than anything that we can get for you on the street or that my MYGA feed is showing, then you stay with that carrier. I mean, you're going to win. Or if they offer something very low, then we're going to transfer it to another carrier with a higher rate. Just understand this. It will never happen, ever. Even if my Learjet hits the mountain, no, I don't have Learjet. But if I die, it's never going to happen. We have systems in place and best practices in place and protocols in place so that our team's going to be in touch with you 60 to 90 days before the MYGA matures in order for you to make the decision on where you want the money to go, or if you want the money to come back to you or to go to another IRA. We are not going to allow an annuity company the MYGA company that has your money to lock you in at a low rate. Just not going to happen. That's what they want to happen, but it's not going to happen with us, which is the reason you need to choose us for all your MYGA purchases. So with that, hey, we're going to do these a lot. It's not going to always be on MYGAs. It's going to be on different product types. I appreciate you joining me on the inaugural The Annuity Man YouTube live event. It's certainly not our last one. I so enjoyed it. I encourage you to go to my site, theannuityman.com, for all things annuity, and I'll see you next time on The Annuity Man Live YouTube.